Hey everyone, welcome back to the channel. We are once again talking about the one big beautiful bill and some of the tax law changes coming your way in 2025. If you missed the previous video, we talked about some of the headline items, mostly good news for taxpayers. Today we're talking about some of those negatives. It is a very complicated tax code and it's pretty much impossible to pass legislation without it having a negative impact on some taxpayers. And let's find out if you're part of that group. Be sure to like, subscribe, leave a comment, and stick around to the end because some of these items you can do some things about. Let's get into it. Item number one is gambling losses. They are going to be limited to 90% of your gambling income starting in 2025. Gambling losses have always been a thing that's kind of a tricky item to explain to people because you got to report your gambling income. If you have one good day, you win some money, but if you gamble regularly, you most likely have losses far in excess of that. You take those losses to the extent of income, but that income is reported on your return as an above the line item, and the losses are taken as itemized deduction. If you don't itemize, no benefit. If those gambling losses are enough to make you itemize, then you're getting a benefit. If you would have itemized anyway, regardless of losses, then the losses would directly offset the income. You wouldn't feel it. Under the current law change, no matter what, even if you're itemizing and you would have itemized regardless, those losses are only going to offset 90% of the income. If you gamble regularly, it's something to be ready for. There's not really much you can do about it. Just know it got a little worse in 2025. Number two, for those who itemize and take a charitable deduction, their charity will only be deductible to the extent it's over 0.5% of their adjusted gross income. There's an income floor that's cutting off a little bit of your charity. We see this to a great deal on medical expenses. You only get medical expenses to the extent they're over 7.5% of your adjusted gross income. That takes a lot of medical expenses. If your adjusted gross income's $100,000, then you need $7,500. On charity, it's not going to be like that. With $100,000 of income, you're just cutting off $500 with 0.5% times 100,000. You won't feel this to a great deal, but just be aware of it. I think this is just a pay for because on the flip side, if you don't itemize, they've brought back an above the line charitable deduction, $1,000 single, $2,000 married filing joint. So I think to pay for this, they have this haircut. On the flip side, if you are itemizing, you're going to get a little bit of your charity cut off. All right, number three. This one is more complicated and we're likely going to do a full video breakdown at some point. This gets to the interplay between your qualified business income deduction for specified service and trade businesses. Think lawyers, accountants, white-collar professionals who tend to get paid for services they provide to clients. They've always been limited on their qualified business deduction, QBI. At the high ends of income, it gets completely phased out. Under the new law, there's also the state and local income tax deduction of $40,000. That's another deduction that's a benefit, especially to high income tax earners in high tax states. The kicker here, though, is these both have a similar phase-out range. Levels of income around $500,000. Both of those deductions are phasing out simultaneously. And what this gives you is high effective tax rates. As you go from $500,000 of income to $600,000 of income, you are paying effectively. We've run some scenarios where you're paying upwards of 50% income tax rate on that last $100,000 of income. Over $50,000 of that 100 goes to income tax. So that's way higher than the 37%, the top income tax bracket. And what that means, especially if you're a tax preparer, or you're a financial planner, you're helping advise people, for your clients who fall as SSTBs, they often are people who are billing hours, they're billing clients. They have a high level of control over how much they're working and therefore how much they're billing. So tell the workaholics down there, go to the golf course more, go home, spend some time with your family. It's not going to do you much good. You're going to be paying Uncle Sam a whole lot of money when you go from $500,000 to $600,000. These are high earners, but they are paying a very high tax rate at this very specific amount of income. Okay, let's talk about number four, tips and overtime. It's great news for those who earn that. They're going to have some real tax breaks here, but you're likely not going to feel it until you file your taxes. 6-9 months from now. The W-4 is not going to change probably for many months, and it really won't impact 2025. It just takes a long time for the IRS to roll it out and then for employers to implement it. So if you want to benefit now from real dollars in your pocket, go ahead and adjust your withholding, especially if you've looked at your 24 taxes. I had over $25,000 of tip income, or I had $20,000 of overtime. You can consider changing your W-4 now to increase the money in your pocket each paycheck. It doesn't increase or decrease the overall benefit. When you file your taxes, everything gets reconciled. So if you're owed money from the government, they're going to refund you, but you're just waiting longer for that big refund rather than getting the money now. That's all I got for you today, folks. Those are 4 tax traps to be aware of in 2025 and going forward. If you liked this video, be sure to like, subscribe, and hey, between you and me, this is a small channel. So give me a comment. I'd love to hear what your tax questions are on this bill or otherwise. It's easy for me to respond to them directly, or if it's more complicated, I'll do a whole video. I'd love to do that. So thanks for watching, and we'll see you next time.